Shares of Target surging this morning, the company delivering better than expected results for the holiday sales period. Headlines from the report include strongest same-store sales growth in more than 10 years, 5 straight years of online sales growth above 25%. Target helping boost the overall retail space. Watching the XRT, it's up more than 11% so far this year. Target CEO Brian Cornell joining Squawk Box earlier this morning, talking about the health of the consumer, slightly tamping down his rhetoric that we heard from him back in August. Listen.
I think it's still a very stable consumer environment. Consumers are shopping. You're seeing strong consumer confidence still. And our outlook for next year is that we'll see consistent results across 2019. So certainly we're going to watch it carefully, and it's going to ebb and flow. But right now, I think we're seeing a pretty consistent consumer environment.
Very stable. Instead of the best he's ever seen. Joining us now, former Toys R Us CEO, former Target Vice Chairman Gerald Storch. Also with us is Cowen Senior Equity Research Analyst covering retail, Oliver Chen. Welcome back to both of you. So Jerry, Target is really distinguishing itself. What is Brian Cornell doing right?
Well, this is really the victory for the all-channel or omni-channel model. We saw strong sales in stores, and we saw strong results on the internet. It's the same thing, by the way, we saw out of Target's bigger brother, Walmart, when they reported. And what's so cool about this is that, as we've talked before, there is a gross margin hit as you grow e-commerce. And you saw that in Target's numbers and in Walmart's. There's about 40 basis points. But they were able to offset that with corresponding expense rate reductions to keep the operating profit about flat. So that's about as good as it goes, and that's the model going forward for the people who can afford to invest, like Target's done and Walmart have done, so they can succeed in the future. So
Jerry mentions Target and Walmart, 2 success stories at least this quarter. And recently, Oliver, Target's a lot cheaper than Walmart, looking at PE. How does the valuation stack up to you?
Yeah, we are recommending both Target and Kohl's. Target's PE is 12, Walmart's around 20, and Target put out some attractive guidance here. So I agree with Jerry, and the fact is the consumer's in a strong place in terms of the low and middle end consumer and what's happening, low unemployment and wage growth. That's helping drive traffic. The second major point is bricks and clicks and really merging the stores and digital channels. And both Kohl's and Target are doing a great job here. And finally, the cost of business is going up. Margins are pressured, and the competition with Amazon remains very prominent. Over 80% of Target shoppers also shop at Amazon. So it's something we continue to watch. But overall, both Kohl's and Target, great prints. They beat and raised. Kohl's had some interesting tidbits. February was a little bit softer because it was colder, so that's something we're watching as well. And they signed a deal with Planet Fitness, which is a game changer in terms of bringing people into Kohl's stores. As they did the standard to small initiative, they can add Planet Fitnesses to some of their retail space. So that's very exciting as well.
Interesting. To your point, Jerry, Cornell is quoted this morning as saying, as the shakeout continues, the separation between those who can afford to invest and those who can't is real. So how do we know who can and who can't?
Well, we've been talking about it for months. The winners will be those who offer real value to the customer. It's companies like Costco, which we haven't got their actual operating results. We got their sales, and they were spectacular, almost 8% same-store sales for the holiday season. So Costco is very strong. Target, Walmart. I like the value players like TJ Maxx or Burlington or Ross stores. They're going to offer value every day. The dollar stores. These people will win no matter what. And they've been doing things right. Now, for those who can afford to have a great e-commerce operation, that's good too. One thing about Kohl's, it's not the same as Target. They certainly did well, and the CEO there is doing a fantastic job. But their situation's a little tougher due to the characteristics of their product. They sell a product that is relatively low price, and you know, it's very difficult for them to operate a profitable e-commerce business at Kohl's. So there they have a much greater negative arbitrage as e-commerce grows than what you're seeing out of many of the other businesses.
So many of these stores, and Oliver, Target included this morning, talking about the web orders where you pick up in store. That seems to be the hot growth area. Kroger talks a lot about this. I mean, the grocers, Walmart talked a lot about it in their quarter. I mean, how are they? Is this just a higher margin business than they thought? What's
vastly
working?
Better when you pick up in store. You don't have the delivery expense. That last leg blows away your expense rate. It's terrible to deliver something to someone's house. To pick an order just for Sarah and deliver it to Sarah's fancy address
Yeah,
and to have to deal. I mean, it takes forever, and it's outrageously expensive.
I don't get it. Is it a suburban thing? Because I would rather it be delivered to my house. I don't want to go to the store.
That's New York. People love going to the store. Target said 75% of their orders were fulfilled from the store on e-commerce. And, you know, some of that is simply they're picking from the store and shipping it to the home that's closer than having to go through a pick and pack DC and bear that expense in order to ship it to you.
Oliver, what were you going to say?
Yeah, Jerry's right. Regarding buy online, pick up in store, what you also find is there's an attachment rate. So when you go into the store, 25 to 50% of the time you buy something else. That's a big helper. Also, another game changer is curbside pickup. So Walmart's expanding this aggressively. Our Cowen data says about 10% of people have used it. You drive up and you pick up your items and they put it in your car and you leave. That's really changing the game. It's the next generation for how this will work. But it's very expensive to pick and pack and ship direct to consumers. If they can really encourage consumers to continue to walk in the store, you save on fulfillment costs, you save on shipping costs. And customers do like immediate gratification as well. That's another positive. So this is a trend that we're seeing in really physical retail using stores to their advantage, and the emergence of retail superpowers such as Target, Walmart, and Amazon, and others that are really rushing to build these capabilities, which are anchored in speed. Very simply, people want their goods as fast as possible, where they want it, when they want it, how they want it, and that's the millennial mindset.
Is the speculation that this yet unconfirmed Amazon retail concept is going to be pickup heavy?
Well, absolutely, and you know that's why they bought Whole Foods. It's why they're getting even heavier into grocery. Grocery is perishable. It's almost impossible to distribute that from a central location, though some have tried and not succeeded, like Webvan and others that tried before. So this is what they know, is they're going to really succeed in e-commerce for food. It's going to have to be delivered to your home from a nearby location, or you're going to go to the store to pick it up, which is what Walmart has been doing incredibly effectively. They mentioned a big part of their growth was grocery pickup, either in an existing store or the specialized areas they have for just grocery pickup.